Hello, welcome to episode 2 of How to Be Smart with Your Money with Shirley Liu and Associates. Today we're going to be talking about the second index that is given by National Life through their family of National Life Indexed Universal Life Insurance products. Last time we talked about the Credit Suisse UBS Balanced Trend 5% Index. Today we are going to be talking about the US Pacesetter Index, and this index is quite different from the one that we viewed earlier. So as we can see, this does reallocate on a regular basis, just like the UBS Credit Suisse. This is important right here. This reallocation happens regularly. It actually happens monthly, and it is based upon the fund maker's opinion on market sentiment, basically. So there are three different qualifications for the allocation of this particular index. There's the growth phase, which is risk on, means risky, a lot of S&P, a lot into equity, and they're reducing a lot of their allocation into bonds or commodities or safe things like that. Intermediate phase is a transitional phase, so transitioning over from a bull to bear market, and a shrinking phase is what this fund does in a typically bear market, so just generally more commodities and more bonds. So that is the allocation strategy of this particular fund, and it changes based on a month-to-month basis. So if we look at this is the exposure chart. This is the basically the chart to how much the index is actually being invested and how much the index is being invested into direct cash. As you can see right now, it's at 110%, so it's a little over the entirety of the index is being invested. We take a look over here. This is important. This is probably the most important part, is the actual performance of this particular index. Now, this index was created right here in about December 20th, 2021. That's when the index was formulated. So let's look at it on a yearly basis. As we all know, the S&P 500 has returned amazing this year. Not year to date, but year over year, the S&P 500 has returned 25%. The US Pacesetter, this index, has only returned negative 0.06%, which of course is not great for people who are invested in this index or the actual insurance policies that use this as the index for their underlying cash value. The S&P 500, as we can see, absolutely outperformed this particular index, which of course makes sense because the S&P 500, you're investing directly into the stock market. This is a volatility controlled. Again, the title, US Pacesetter, this is pacing you, right? It is a stable growth, slow growth. You know, this did not grow, but it is slow growth, nevertheless reallocated. It is stable. It is looking at the market and deciding whether it is a good time to be risky or a good time to be or to play it safe, right? So let's take a look at the monthly performance. Again, this is year to date. So from January to June 6th. As we can see, the S&P 500 has returned 12.2%, and this particular index has returned 0.7%. So it is up for the year, but it is nothing compared to the S&P 500. There is a difference of 11.6%. Not great. And we can see the same thing over here. 2023, this particular index returned 1.9% and 24.2% S&P index. So again, 22% difference. The S&P far outperformed this particular index. Important point though. As we all know, 2022 was a bear market. What did the Pacesetter do here? Look at this. The US Pacesetter returned negative 15. Of course, it lost money, but it lost less money than the S&P 500, which means that this would have actually been a better index to invest in if you were just investing directly into the index. But there's one important point here. IULs have a 0% floor, so it doesn't matter if you are less negative than another negative, because at the end of the day, you're not going to be going negative with the cash value because it has that 0% floor. So although this US Pacesetter performed better than the S&P 500 in 2022, which was a bear market, you wouldn't have actually seen all that much benefit if you were invested in an IUL. If you were invested directly into this index, whole different story. Would have been a better index to invest in. So that is how the asset kind of works. Here is a little more information. Of course, these are the different things. Whenever it's in a growth phase, it is 50% in the S&P, 30% in bonds and fixed income, and 20% in commodities. Intermediate phase, 15% in S&P, 65% in bonds, and 20% in commodities. Shrink phase is 5% in equities, 75% in bonds, and 20% in commodities. And this changes on a month-to-month basis, depending on whatever Society General thinks. That is the performance. We can also see the asset exposure. This is also important. This 5% right here, this controls with a 5% volatility scale. If it said 7%, it would be a little less controlled and it would be a little more volatile because it is rotating between 7% rather than 5%. So let's take a look at one more thing. This is one of the most important things. This is the, I think, kind of interesting to see. As you can see on my screen here, this is the historical weight allocations that this fund has engaged in since its inception. So let's take a look. So if we go down, this is when it was created. Now, if you recall, 2022 was a bear market, right? As we can see, this column right here to the far right is S&P. So when there was a bear market, it did not realize that it was a bear market for quite a while. As we can see, there are a ton of 50% allocations, which means that it believed that it was a bull market. It was not. Quickly adjusted and realized, oh, yep, this is a bear market. Went down to 5%. That's why it returned slightly better than the S&P 500 in 2022. Now we can see where they went wrong after 2022. 2023 and 2024, the market we're currently in is absolutely bull. We know this for a fact. The market is at all-time highs. It reaches all-time highs practically on a daily basis. As we can see, if we go to current times, right now it believes that we are in a transitional market based on its theory of investment. If you recall, it goes to 15% allocation for the S&P when it believes the market is in transition. Right now it is in fact at 15%. So this particular index is underweight in S&P and overweight in bonds. If you look before that point, there was a short bull period of 50% that it believed. And then before that, it was again at 15%. So as you can see, right now, this particular index is predicting a transitional market. However, as we can see, in 2023, it also predicted, let's go back to 2023. We can see a bunch of 15% here. Again, it is reallocating on a daily basis. But as you can see, this reallocation doesn't really do much. Because although it's reallocating gradually from 15 to 20 to 29 to 36 to 43 to 50, we can see that 50% is just not going to cut it, right? I mean, look, we go back to the S&P performance. S&P has outperformed it year to date 12.2%. If this was truly a successful index, it would have maintained that 50% weight for the entire time. I know it's trying to control for volatility, but again, you have to consider this is being managed by humans. It is not being managed by the actual market fundamentals. So again, this is a stable index. I believe that this is far superior to the UBS index that we looked at yesterday. But again, I do not think that if you are an aggressive investor, not an aggressive investor, but an aggressive investor within your insurance policy. Of course, insurance should never be used for investing. It is just a tool to build up your cash value. But in terms of growth, if you are younger, I would again suggest investing, putting a portion of your cash value into an S&P 500 index. And if you're on the older side, I think this is a wonderful index for you because it is reallocating. It is more stable. It does better in bear markets. And this would be a better index if you were on the older side of your indexed insurance life policy. But again, if you are on the younger side of having an IUL, I think the S&P will always do wonders for you. So thank you. That is episode 2. And next time we'll take a look at the last index that is used by National Life Group.